You got the job, good salary, benefits, maybe even a bonus. You work hard, you get raises, you pay your taxes like a responsible adult. And somehow, decade after decade, the guy who owns the building you work in keeps getting richer, faster, with less effort. You're not imagining it. There's a structural reason this happens. It's not about hustle. It's not about mindset. It's not a conspiracy. It's the tax code. And once you understand how it actually works, how different types of income are treated completely differently by the government, you'll see why climbing the salary ladder is, at best, running on a treadmill, and at worst, a trap. Let's talk about money. Specifically, whose money gets taxed more. Here's the thing nobody tells you in school. Not all income is equal. Two people can both make $200,000 in a year and pay wildly different amounts of tax. How? Because of where the money came from. If you earned it by working, trading your hours for dollars, that's called earned income. Also known as ordinary income. It's your salary, your freelance payment, your bonus. If the money came from an investment, a stock you sold, a rental property, dividends, that's called capital income, or passive income, depending on the structure. The government taxes these two types of income differently, very differently, and that difference is basically the entire game. Let's start with your salary, because this one you already know, even if you don't fully realize what's happening. You earn $80,000 a year. Great! Except before you see a single dollar, the government takes a cut. Federal income tax. State income tax in most states. Social Security, 6.2% off the top. Medicare, 1.45%. Your employer also pays Social Security and Medicare on your behalf. Another 7.65% of your paycheck. You don't see that. It just disappears. It's part of the cost of you existing as an employee. By the time everything shakes out, your $80,000 salary might leave you with somewhere around $57,000 to $62,000 in many states after federal and payroll taxes. The exact number varies by state and situation, but you're routinely handing 25 to 35% of your earned income to various levels of government before you buy a single thing. And if you earn more, say $400,000 as a senior employee somewhere, you hit the top federal bracket, which as of recent years sits at 37%. 37 cents of every dollar above a certain threshold goes to federal taxes alone. That's what earned income looks like. Now, the investor. Same year. Different person. This person made $200,000, but they made it by selling stock they'd held for over a year. Their tax rate on that gain? 15%, maybe 20% if their total income is high enough. Possibly even 0 if their income is low enough. That's the long-term capital gains tax rate. It's the rate applied to profits from assets, stocks, real estate, certain other investments when you've held them for more than 12 months. Compare that to the 37% bracket on earned income. Same country, same year, same dollar amount. One person pays 37 cents on the dollar, the other pays 15 to 20 cents on the dollar. This isn't a glitch, it's policy. It's been debated for decades, and it fundamentally shapes who gets rich and how fast. Fair question. The standard economic argument for taxing capital gains at a lower rate goes like this. Investment is good for the economy. When people invest in companies, it creates jobs, funds innovation, grows the economic pie. So the government incentivizes it by taxing it less. There's also an inflation argument. If you bought a stock 20 years ago for $10,000 and sold it for $30,000, some of that gain is just inflation. You're not truly $20,000 richer in real purchasing power. Taxing it at full rates would be taxing inflation itself. Those are the policy arguments. You can agree or disagree with them. What you can't disagree with is the outcome. The system creates a structural advantage for people who can make money from money versus people who make money from work. Here's where your paycheck starts to look like a trap. When you earn a salary, you pay taxes on every dollar you make. You can't defer it. You can't hold it for a year and get a better rate. You show up, you work, you get taxed immediately at the highest applicable rate. And then you spend what's left. Rent, food, car, subscriptions, the occasional dinner out that costs more than it should. Whatever's left, if anything's left, goes into savings or a 401k. Now compare that to someone with capital, someone who put $500,000 into a diversified stock portfolio 10 years ago. They haven't worked for that money in the traditional sense. The money just grows. The market goes up. Dividends get reinvested. And until they sell, they pay zero tax on those gains. Zero. Unrealized gains, meaning the value has gone up, but you haven't sold yet, are not taxed in the U.S. system. The money grows, tax deferred, for years or decades. Then when they do sell, they pay 15 to 20%, not 37%. This is the compounding advantage that salaries don't get. Every dollar your salary earns is taxed immediately. Every dollar an investment earns is taxed later at a lower rate, and the untaxed portion keeps compounding in the meantime. Let's make it more concrete. Say you own $2 million in dividend-paying stocks. Boring, established companies that pay out quarterly. At a 4% dividend yield, that's $80,000 per year in dividend income. Qualified dividends, which most standard stock dividends are, get taxed at long-term capital gains rates. So again, 0%, 15%, or 20% depending on your total income. An $80,000 salary, taxed as ordinary income. Federal bracket around 22 to 24% for a single filer, plus payroll taxes, plus state taxes. The dividend recipient making the same $80,000 could pay a 0% to 15% federal rate, no payroll taxes, and potentially lower state taxes, depending on where they live. One person showed up every day for a year. The other had money that worked while they slept. Guess which tax bill is higher? Here's something that often gets missed. Social Security and Medicare taxes, collectively called FICA, apply to earned income from wages. As an employee, you pay 6.2% plus 1.45% equals 7.65%. Your employer matches it. That's 15.3% of your wages, split between you and your employer, before federal income tax even enters the picture. If you're self-employed, you pay the full 15.3% yourself. That's the self-employment tax. Investment income? No FICA. 0. Capital gains don't pay into Social Security. Dividends don't pay into Medicare. Rental income doesn't pay payroll taxes. So not only is the rate lower on investment income, there's an entire category of taxes that investment income completely avoids. You might be thinking, but I have a 401k. That's investing. Yes, and it helps. A lot, actually. A traditional 401k lets you contribute pre-tax money, which reduces your taxable income now, and the investments grow tax-deferred until retirement. A Roth 401k lets you contribute after-tax money, and the growth is tax-free. These are genuinely good tools. Use them. But here's the ceiling. As of 2024, the 401k contribution limit is $23,000 per year if you're under 50. That's not nothing, but it's a cap. And the money is locked up until you're 59 and a half without early withdrawal penalties. It's not liquid wealth you can deploy. The ultra-wealthy aren't building their fortunes primarily inside a 401k. They're building them outside it, through business ownership, real estate, and equity in companies, where the gains are taxed at capital rates or deferred essentially indefinitely. Here's where it gets really interesting. When you own a business, not just work at one, but own one, the rules change again. A business owner can deduct legitimate expenses before paying taxes. Home office, vehicle use, equipment, business travel, software, professional development, healthcare in certain structures. An employee gets a salary and pays taxes on the whole thing, then buys their work laptop with after-tax dollars. A business owner earns revenue, subtracts legitimate business costs, and pays taxes on what remains. This is called operating pre-tax. It's a fundamental difference in how money flows. And then, if the business grows and you sell it, that's a capital event, often taxed at long-term capital gains rates, sometimes structured with further advantages like qualified small business stock exclusions. This is why entrepreneurs who build and sell companies can generate extraordinary wealth in a single transaction. and keep far more of it than someone who earned the equivalent over 40 years of salary. Real estate is its own universe of tax treatment. Rental income is taxed as ordinary income in many cases. Not great, but here's what makes real estate a wealth-building machine for many people: depreciation. The IRS assumes a property wears out over time, 27.5 years for residential, 39 years for commercial. So even if your property is going up in value, you can take a depreciation deduction every year as if it's losing value. This often means your rental property generates positive cash flow while showing a paper loss for tax purposes. You're making money and writing off a tax deduction at the same time. When you eventually sell, you pay capital gains rates on the appreciation, and you can defer even that by doing a 1031 exchange, selling one investment property and rolling the proceeds into another, deferring the capital gains tax indefinitely. Some real estate investors do this their entire lives. They never pay the capital gains tax. They pass the properties to their heirs, who get a stepped-up basis, meaning the cost basis resets to the current market value at the time of inheritance. And the embedded gain disappears entirely. The tax that was deferred for decades just goes away, legally. Buy, borrow, die. Speaking of that, the ultra-wealthy have a specific strategy that deserves its own moment. It's called buy, borrow, die. And it is genuinely a real thing. Here's how it works. Buy. Acquire appreciating assets. Stocks, real estate, business equity. Borrow. Instead of selling, which would trigger capital gains, borrow against the assets. Take out a loan using your portfolio as collateral. Banks love giving these loans to wealthy clients. It's called a securities-backed loan or pledged asset line. You get cash to spend, tax-free, because borrowed money is not income. The interest on the loan, sometimes deductible as investment interest. The assets keep appreciating while you've borrowed against them. Die. When you die, your assets pass to your heirs with a stepped-up basis. The capital gains that build up over decades get wiped out. The estate may owe estate taxes depending on the size and current law, but the capital gains themselves disappear. This is a legal strategy. It's not illegal. It's not even a loophole in the traditional sense. It's the intended consequence of how the tax code was written. Jeff Bezos, Elon Musk, Warren Buffett. All have discussed or been documented using variations of this strategy. Buffett famously pointed out that his effective tax rate was lower than his secretary's because his income came from capital rather than wages. So, what do you do? Okay, real life. Most people reading this don't have $2 million in a stock portfolio. They have a job, maybe some 401k savings, and rent that goes up every year. So what's the practical takeaway? First, understand the game you're playing. If you only ever earn salary, you are always playing on the hardest tax setting. That's not doom. It's just reality. Second, start building the other side. You don't need to be rich to invest. Index funds, Roth IRAs, taxable brokerage accounts, these are accessible. Every dollar you invest is a dollar that starts generating capital income instead of earned income. Third, if you ever start a business, even a side hustle, understand that your structure matters enormously. How you're paid, what you can deduct, and how you might eventually exit are all tax decisions, not just business decisions. Fourth, time is the variable you can actually control right now. The reason compound growth is powerful is that it needs time to work. Every year you delay investing is a year that money could have been generating capital gains, taxed at 15%, growing untouched. The system is what it is. You didn't design it, but you can understand it. And understanding it is the first step to not being surprised by it. Quick recap. Let's run through it fast. There are two main types of income: earned and capital. Earned income, your salary, your wages, is taxed at ordinary income rates. Up to 37% federal plus payroll taxes. Every year, immediately. Capital income, gains from assets you sell, is taxed at lower rates: 0%, 15%, or 20% for long-term capital gains. No payroll taxes. The wealthy build wealth primarily through capital income, not salary. They also use strategies like depreciation, 1031 exchanges, and borrowing against assets to defer or eliminate taxes further. Business owners can deduct expenses before paying tax. Employees pay tax first, then spend. The stepped-up basis rule means unrealized capital gains can disappear entirely at death. 401ks are a real and useful tool, but they're not the mechanism by which most significant wealth is built. The practical move: understand the system, invest as early as possible, and build income sources beyond your salary. The tax code rewards capital. So the goal is to acquire some. Outro. If this made you want to rethink your relationship with your paycheck, or at least understand why your landlord seems to have a weirdly nice car, hit subscribe. Next time you file taxes, you'll know exactly which game you're playing, and maybe, just maybe, you'll start playing a slightly different one.